Hey everyone, welcome to our webinar on annual planning with Jirav. I'm your host, Shreyas Mecheri, and I'm excited to host this great panel we have today for you. Let's get right into the introductions because we have a lot of content we want to cover with you today. I'm also going to give people a few more minutes to join in because I'm seeing more and more folks rolling in right now. All right. I think it has started tapering off. So let me go ahead and introduce your panel today. So we have Katie Terino, who is President and CEO at House of Possibilities. And she has extensive experience with nonprofits. She's on multiple boards, but she owns the budget right now at House of Possibilities. And she's a Jirav customer. Next, we have Adrianna, who is a director of professional services here at Jirav. Adrianna has helped hundreds of customers implement their FP&HEY software, and she has seen all kinds of cases you can have when it comes to annual planning and budgeting. So she will be actually walking us through actual demonstration of how it is to plan in Jirav. Next, we have Drew from FP&HEY. And Drew has been a CFO. He has worked in multiple FP&HEY roles over 20 years, from companies ranging like Vistaprint and startups to companies like P&G. And finally, we have Yarty, who is also a co-founder at FP&HEY. And if you haven't read FP&HEY, they have put out a lot of fun content around the concepts of FP&HEY. And Yarty also manages his own accounting practice. So he brings that perspective in as well, in addition to FP&HEY experience. Quickly in the session today, some housekeeping items. If you have any Q&A questions to ask us, just drop them in the Q&A section you see at the bottom of your Zoom tab. And we will be recording this entire session and sending you a link to it, which you'll get tomorrow with some other resources as well. And finally, we have 1 or 2 polls through the session. There is no CPE, but these polls are just meant for engagement. And we encourage you to just participate. It helps with making sure that we are tailoring the content to our audience. So what will you learn today? We will walk you through a 4-step framework for annual planning that we have found to be very successful with customers over the years. This is not the first time we are doing a webinar like this. We have tweaked the content over time, but we found that this 4-step framework is, works all the time. We will also see how to actually build plans, scenarios, and share reports using Jirav once you have done that planning. And then finally, we will, throughout the session, have our panelists keep us updated on what's the latest, what do they encounter as they go through the process. So with that, our first poll question is coming up. The question is, do you refer to this process as annual planning or annual budgeting? We've heard different companies say it different ways. So the first question we want to ask is, what do you call it in your company? We'll give folks a few minutes to answer. I see the answers coming in, and I'll leave it up for 10 more seconds. Drew, what do you think the top answer will be?
I usually go with budgeting, so I'm going to go with the second one.
Okay, I see the answers have kind of tapered off, and I'm going to share the results here. Folks should be seeing the results, and actually, yes, annual budgeting is what is most commonly used by most companies. So with that, let's get into the basics of annual planning before we dive into the details. Drew, you recently wrote an article for us about the annual plan. Can you just hit on some of the highlights from the article for us?
Sure. So I'm sure for many on this webinar, the word annual plan or budget is synonymous with not so nice 4-letter words. It's actually not that bad. The annual plan is your company's financial roadmap for the upcoming year. The best annual plans will align your company's goals with desired financial results that every department in your company can somehow relate to and measure themselves against. That's why having a thorough, well-done annual plan is important. There's so many moving parts with all your businesses and so many decisions being made every single day. I'm sure everyone on this webinar can relate to this in some way, shape, or form. And all this can be daunting. So how can you ensure all these things contribute to your company's goals for next year? Well, the answer is why we're here today, the annual plan. Surprise. So it's important that your annual plan involves not just your finance teams too. It's not just your CEO or CFO. Sorry, Katie, but it involves literally everyone, your entire leadership team, and honestly, all the people managers and anyone responsible for making hiring or spending decisions. Because when everyone's connected to your company's goals and then held accountable through various things like KPIs and metrics, two things will happen. One, your entire organization will start moving in one direction, and the direction will be where your company goals lie. And then the second, you'll be able to measure and adjust your annual plan throughout the year. Because just like the weather, you can make predictions all you want, but things are going to change. So I guess with all that said, yeah, the annual plan is kind of a big deal. It should be thoughtfully done over a period of time and with collaborations across all levels of your company. How's that, Shreyas? All right?
Yeah, that sounds great. And as you were speaking, there also a message came in saying that budget tends to have a negative connotation to it, which actually brings me to a question I have for you, Yarty. Annual plan or annual budget, and why, from a mindset perspective, why is one better than the other?
That is a great question. And you can kind of see it in the polls. It was really mixed. And most people have heard the word annual budgeting. And Drew and I, we started our careers at Fortune 500 companies, and they call it an annual budget as well. And it really comes down to whether you call it a plan or a budget. Are you thinking about what you're about to achieve in your goals and objectives thoughtfully? Do you have a plan, as we call it, an annual plan? And if you think about it, when you're going from, let's say, point A to point B, it's never a linear line. There's bumps, there's bruises, there's things that are happening in between. And that plan allows you, your executives, your people managers, and everyone underneath to think about what's going to happen. And what's great about that too is everyone gets to be involved in that process. When I was in my career early on, it was, I don't know what I'm doing here. What do these numbers mean? In the software like Jirav and just companies in general, where they're thinking about this process, they'll go to, let's say, your customer support manager and say, what do you think about this? And it's a great way to get everyone involved, because I think, in short, everyone wants to be involved in these processes. So me personally, I like the word plan over budget. And as the one of you had shared, I think budget has a very bad connotation to it. But yeah, that's how I see plans. And I think it just enables everyone just to be involved in that process.
Yeah, thanks, Yarty. Well, to that angle, right, Katie, what gets in the way of annual planning? What do you think? We've heard why it's important, but then what gets in the way? And more importantly, how do we get around that obstacle?
Yeah, well, I think a lot of things can get in the way. And, just speaking from experience, particularly in resource constrained nonprofits where you've got a lot of work to do with less resources, limited time and resources can get in the way. As Yarty also alluded to, sometimes you can experience challenges in achieving that collaboration that really gets you that really strong annual plan. Having clear goals and objectives and deadlines, hold yourself accountable. And the annual planning process really is an annual exercise as well. Another thing I think sometimes gets in the way is perfection, right? The annual plan is your best guess in terms of where you think you're headed and where you want to head. And if you spend too much time getting it perfect, sometimes it can hold up the process. And then I just think, change in general, right? You've got changing priorities, changing market conditions. There's new opportunities and threats that we're all facing every single day. And this is where I think having a flexible and dynamic tool can really be a game changer, especially as the pace of the world seems to be just getting faster and faster. Having a tool that can adjust quickly, it can really help your organization to stay on track with the annual plan.
Thank you. Well, let's do a quick recap of what we've learned so far. Annual plan defines the resources you'll need to achieve your business goals. And it's about making a thoughtful plan that will get you on the where you need to go. And finally, as it's been mentioned, bring along everyone on the journey. You really need that collaboration and alignment to actually get there. With that, I'm going to pass it on to Adrianna, who's going to walk us through our planning framework.
Okay, so now that we've talked about what the annual plan is, or the annual budget, I'm going to dive in a little bit about how we actually get there. So the framework we use here at Jirav is based off of 4 main pillars. The first one being goal setting. So we have to figure out where we want to go first, and before we go into our second phase, which is kind of creating a blueprint to get where we want to go. That's going to be the build of our model. And once we have that blueprint built and the model created, then we can start kind of forecasting and budgeting and figuring out kind of what materials do we need to make this budget happen. You know, if we have a goal to increase revenue, then we need to think about, well, are there salespeople that will go into that? Is there increased marketing spend that we need to go into that? And that's really like the meat of the budgeting process to me. And then lastly, and also possibly most importantly, is tracking progress to that goal. So it's great to set a goal, but we have to make sure that we're going to abide by that goal so that we're successful over the year. So just drilling in a little bit more to goal setting. I think that it's important to pick ones that are kind of specific to where you are as a company size, what industry you're in, and what your strategic priorities are. Here we have some very common ones, such as revenue growth or cash flow management, reducing debt. But again, the goal is going to depend on your business and your stage. Right. So once you have your goal, bringing back to the 4th pillar, is we have to figure out how we're going to track success against that goal. So for example, if we had that goal of revenue growth and we're going to have a measurable goal, so we're going to say we want to increase revenue by 20%, then we have to think about what metrics or what KPIs we can use to track that. So we could look at things like the year-over-year growth rate, might look at the overall customer lifetime value for your current customers versus maybe future customers. And also looking at success against monthly and quarterly sales targets for your sales team. Oops, sorry, can I go back one, Shreyas? Wasn't ready yet, accidentally. Okay. Okay, so in summary, the most important thing to me for a goal is to set a SMART goal, which you probably heard of before, which is specific, measurable, achievable, relevant, and time-bound. And then regular review of these goals throughout the year will ensure the financial health and success of your organization. So with that, we'll launch into the next poll.
Right, thank you. So this next poll is going to be around what is, when you're setting goals at your organization, and if you're an accounting firm for your clients, how many goals do you typically set for the year? I have launched the poll there. And Katie, what do you think is going to be the most likely answer here?
I'm going to go with 3 to 5.
Yeah, I mean, that sounds more manageable, right? Like 5+ might be if you're a larger company or, you know, for a specific situation. The answers have started to slow down, so I'm going to end the poll and share the results here. So yes, again, Katie, you were right. 3 to 5 at like 66% of the attendees is actually one of the highest categories here. And with that, like, I wanted to have a discussion with the panel around goal setting. What are some good principles to have in mind while goal setting, Katie?
Yeah, so just thinking about how many goals to have in the first place, I like the idea of keeping it simple and almost forcing yourself to pick three, because that's really going to force you to prioritize. If I get nothing else done this year and I only get these three, what are the most important three things to get done? So I kind of like less is more because it really forces you to prioritize. I think another thing is that if you're new to annual planning, you're just starting out, it's not an exercised muscle. It's one that you have to build over time. You've got to practice, you've got to get that consistency to really get good at it. I think another thing is that having goals at every level is helpful and important, but you want to make sure that those goals are always aligning back up to the strategic plan and that you have a process in place that allows, no matter what level those goals are being created, that you can trace those back up to the strategic plan and how the overall organization is marching towards it. And then again, I think it's so important to keep yourself and your organization accountable to your goals and checking in. How are you doing on your goals? And if you're starting to go off track, what's your course for correction?
Well, Drew, in your article, you also spoke about what goals would look like for a growth company. Can you tell us more about that?
Sure. So growth can be expensive. So whenever you come up with targets for a growth company or goals for a growth company, the quick thing and easy thing is revenue and customer counts. We're going to double those, triple those next year. It's the companies that have that financial rigor to understand, okay, what is this going to cost? And honestly, even looking a little further out than your annual plan, understanding the drivers of that cost, like marketing spend, like people count and salespeople, so that you have line of sight into, I think it was mentioned before, customer lifetime value by Adrianna. Like that's the type of thing you need visibility into. So when you tell your story, your financial story from year to year, you grew a lot, and then having the line of sight in, yep, we're going to lose money this year and we're going to need to use our revolver or need to raise some money or whatever it may be. But we have a line of sight into how to close the gap because the business model we've created is a scalable one. So that's where I've seen like the greatest growth companies. They aren't necessarily profitable to start and they grow like crazy, but they have that line of sight vision into, we know that this is going to scale and we're going to set ourselves up to do that years from now.
Right. Thanks, Drew. Well, and Yarty, one of the debates I've heard a lot is people not wanting to set their goals or wanting to set their goals. Can you tell us more about this debate around when does a top-down approach to goal setting make sense versus a bottoms-up approach where people are coming up with the goals at all levels?
Yeah, sure is. That's a really good question. And just like everything in life, it really depends. So, and I say that earnestly because if you're just, let's say, starting out a business, a lot of times you might get caught up in that process. You're doing kind of a bottoms up approach. You may not even have that muscle like Katie had mentioned earlier, but you might have an idea. Hey, Drew said, I'm going to double my customer counts. There you go. You can follow that tops down approach. But if you're at a bigger company, and bigger is relative, could be 10 people, could be thousands of people. But that bottoms up approach is also good because it allows your people managers and the people down below that supports your executives to really thoughtfully think about the resources they need. Hey, I need 3 more analysts on my team to support this objective of doubling customer counts. And also, again, goes back to that whole plan versus budget debate of, I want my people involved. I want them engaged in this process. But then there's the flip side of, there's things that from a tops down approach that only the executives understand and know. For example, interest rates are going up. Hey, AI is going to take over my company. There's things like this that are happening where sometimes you need that guidance from the top to funnel it down below. But it really just depends on the size of your company and where you are in the life cycle of your business.
Thank you. Yeah, and we had a question about whether these slides will be shared, and yes, we'll share them after as well. So with that, what we've heard about goal setting is have a few simple goals, and then once you have the goals, identify the KPIs which will actually help you track that you're hitting those goals. And it's different approaches work for different companies, whether it's bottoms up or top down. But finally, you have to be realistic. You're not, in certain cases, you might want to grow 500 times, but considering the economic conditions and other things, you have to be realistic. With that, I'm going to now pass over to Adrianna, who's going to introduce us to Simba. Who's Simba, Adrianna?
So Simba is the company that we are going to help budget and run a different scenario for on this webinar today. So Simba is a software as a service company, and they have built their budget for 2024 with the scenario A, which is sustained growth, kind of growing at the same rate that they did last year. But now we want to kind of run an additional scenario about, well, what if we can do better than we did last year? And what if we can double that ARR target? What does that look like for us as a company? Like Drew mentioned, yes, it's increased revenue, but alongside that, there will be some increased expenses as well.
So now, sorry,
go ahead.
We are going to talk about building the model, which Adrianna is going to walk us through.
Right. So if we remember our framework from earlier, the first step was to decide what our goal was. And then the next step is to build the model. So a financial model is a summary of your company's performance based on certain variables, and those will help you forecast future financial performance. So those variables that we have kind of depend on your business. So you want to identify the key drivers for your business. You know, what are the levers that you can pull to generate change? So you might ask yourself, well, what people and products in my business generate revenue? Is it account executives that you want to be a key driver in your model? Or maybe it's a product. Maybe you think that you're going to increase market share based on a new release. So those are a couple examples of things that might generate revenue, but then you also have to think about the cost of that revenue as well. You know, who are the people I need to fulfill that increased business? So if you're a manufacturing company, you may need more headcount in your warehouse to support the orders. If you are like Simba and a software company and you sign up a bunch of new customers, you may need additional tech support. You might need customer success managers to nurture the relationships. And all of those things will have added cost associated with it. For example, maybe you do have to hire a whole team of tech support folks to support all of your new customers. Well, you might have to buy or upgrade to a bigger office space, which would have an increase in your operating expense facilities cost. Right. So just following up on what we were talking on the last slide, here's a few more examples of drivers that might be relevant to your business, like the sales headcount, your margin percentages, the rate at which your customers churn, right? Because if we increase our ARR a ton, but we have a very high churn, then the net effect is not going to be what we are wanting from a growth standpoint. Also, a very common one is the acquisition cost of a new customer, right? It's kind of that idea of, is the juice worth the squeeze? If it costs us $500 to get a new customer and we're only going to sign them up for a $25 subscription, that's probably not a great business model. And lastly here, website traffic is also a very common metric that I see people drive their models with. Especially in the retail space, or the e-commerce space, I should say, is we want to make sure people are coming to our website or they're not going to know that they can buy things from us. So how do we kind of pull it all together, right? So the drivers help us build that financial model, right? So in our software company, customers equal revenue. Right, so that's there in the middle. That's kind of a key driver for our business, is the number of customers, and that will get us the revenue, but also impacting that customer count would be those churn customers. But how do we get the customers? It's coming from our sales headcount. So for every headcount we have, we're going to have additional customers, but along with that comes that extra expense, like the salaries and wages and the rent. And then also that added cost of supporting all of our nice new customers, which also have those expenses like salaries and rent associated with them. So drivers can have input from leadership teams or the planning team. Everyone within your business has, I'm sure, some opinion about what those drivers should be. And you want to build a model that incorporates that feedback to get a realistic financial plan. Shreyas, you're on mute.
Thank you. Well, so Drew, having heard that, what is the role of finance in your experience in setting best-in-class drivers that are actually relevant?
So this is where finance really needs to get in the weeds of the business. Because in finance, we're kind of useless at doing daily activities to help a company run. I mean that in a way that, like, finance doesn't sell, finance doesn't market, finance doesn't do operational stuff, but finance and accounting people really should be like right next to the people doing that work, because you need to understand what drives activity, what drives people doing things. And when you do that, you figure out, hey, the more customers we have, the more operations people I need. The bigger the target on new customers we have, the more sales reps I need. So yeah, the best finance and accounting people out there that do budgets and help companies grow is really when they take the I'll call it the co-pilot seat. Let other people show you how they operate. Jump on sales calls. Go into your plant if you're in a plant environment. That's where I came from. I did my internships at a shave prep plant. I walked the floor because my mentor told me to 30 minutes a day, and I thought the person was crazy, but it was awesome. I spent a year walking the floor for a half hour learning how machines work. And oh, by the way, when we CapEx, when we have to spend money on new equipment, like, this impacts you and this is how. So get in the weeds of the business, learn it, and the drivers should bubble themselves up, and then you'll work together to understand what that means for hiring and spending plans next year.
Thanks, Drew. Well, Katie, we heard from Drew about how do you pick good drivers. How do you make sure, and how are you finding you make sure they stay relevant over time once you're done with the initial planning?
Yeah. And as you heard, we just ran into this scenario where we had spent a lot of time setting up our drivers in the spring, and our fiscal year ends on June 30th, and then ran a few reports after the end of the year to look at the forecast for the following year, and realized, some of these don't make sense anymore. So I think it's really important to go back to revisit them as time goes on. A really easy and great report that helped us was to look at actuals versus budget versus forecast. And by taking a couple different points in time, some of the drivers that we needed to tweak really stood out. So for example, we had a number of drivers where either the time frame was too long or too short. Really kind of revisiting them and then looking at them across different points in time to just gut check. Does that make sense? What that driver is doing, does it make sense? The other thing is we have a number of drivers that are based on data. So keeping that data updated. We have a number of drivers that are based on actual contracts. Well, those contracts are constantly changing, making sure that that data is updated, make sure that those drivers are operating the way you're intending. And then also the assumptions, revisiting the assumptions, because assumptions change all the time based on different data, different things that we're learning. Do those assumptions still make sense? Do we think we can really still hit that utilization, or do we need to adjust it up or down?
Thanks, Katie. Now we are going to move on. Adrianna.
Right, so kind of following up on what Katie was saying there is we have our model now, but we need to kind of tweak it and see what's most reasonable, and we're going to do that through forecasting and budgeting. Is we know that our business is driven on revenue. That's kind of one of our key drivers here. And we know that as we have more revenue, we'll have more customers, which means we have to hire more customer success managers. But we do need to make some assumptions there. We know they're related, but we have to make an assumption about kind of how many customers, in this case, that a customer success manager could manage successfully. So in this example, we're saying for every 150 customers, we need to hire that customer success manager. And that 150 is an assumption that we need to monitor and make sure it's actually accurate over time. Here's just some more examples of common assumptions that I see built into most financial plans, right? For workforce, we would make assumptions about the fully burdened headcount, right? It's not just salaries. Every time you hire a new person, you'll also have associated costs like payroll, taxes, and benefits. They may also have a software subscription that is per head that they'll need access to. And, maybe for your salespeople, there's an expectation that they'll be traveling. So they also need a travel and entertainment budget for every new employee. Beyond workforce-driven assumptions, you'll also have revenue-driven assumptions. Maybe a marketing budget that's set for the year would be an assumption that you're kind of making that they're going to spend X amount of dollars. And those KPIs that go along with those. So if you approve marketing to spend $1 million, well, how are they going to spend that? What's the customer acquisition cost associated with that marketing budget? And does it make sense? And then lastly on here, we have some customer-driven assumptions. So things like maybe an e-commerce site where there's associated COGS, or you're manufacturing something. The more customers you have, the more product that you have to create. And then also maybe some support requirements, like in our example earlier, if it requires a call center to support your customer base, then the more customers you have, the more people you need in that call center. So next, we're going to actually jump in to our example company, Simba, and kind of look at what that scenario looks like within Jirav, how we would run those kind of two parallel scenarios. One, our base case, the realistic sustainable growth, and then that second, double the ARR growth, we're going to go all in and see what that looks like.
I'm going to stop sharing and so that Adrianna can share.
Okay. So when we log into our Jirav account for Simba, we can see our dashboard set up here for the annual budgeting process in 2024. And we see our targets as they are today. Our goal by the end of the year is to get to the 3.6 million in ARR. So let's take a look at kind of what happens if we run our different scenario where we change the assumption in our model to have an increased ARR growth. Right? So we can see right now, both scenarios are exactly the same for ARR and operating expenses. Okay. So all of the budgeting and forecasting is done here in the plan area of Jirav. So we'll come over here to plans, and we see all of the areas that we built out for our 2024 budget. We have the revenues, the expenses, the staffing plan, and of course the balance sheet so that we can drive our cash flow correctly. So we're going to leave 2024 budget alone because this is our base case. And we're going to go ahead and go into our best case, which is currently an exact replica. So these are our different versions of the plan, just representing two different scenarios. We're still going to plan for all the same areas, income statement, balance sheet, staffing, but this will allow us to compare those changes versus our base case. So for my revenue, I'm going to go ahead into my revenue plan, which kind of has all the extra details that I need to build out a plan beyond just looking at my GL accounts, right? I'm a software company, so I care about other things other than just revenue, like my customer count and my churn, my CAC, my LTV. That all lives here in my custom revenue plan. And I'm going to go ahead and update my assumptions by clicking on my assumptions here. It's going to pull up kind of all of those things that I just made an assumption on. I made my best guess, given the current market conditions, about what I think churn will be, what I think my average contract value is, and what my target is for next year. So to keep the math easy, let's just go ahead and double this. So instead of the 1.5, we want one more zero. Right? So it's highlighting the row that to let me know that that's the row I'm changing here, and I'm changing it for 2024. I'm going to go ahead and hit apply, and it has now recalculated my ARR based on that $3 million target. I'm going to go ahead and leave everything else the same. We'll have the same churn target, the same ACV. But we do see things like our customer count have increased, and in my model that's been built, that will also increase my head count. So let's take a look at kind of, well, what changed, right? I know my ARR increased, but what else changed? So we have our dashboard view, which gives us kind of the high level look, the graphs, charts, but let's go over to reports and look at more of a tabular style report to see the difference between my base case and my best case budget. Go ahead and pull up my report here. And these tiles might look familiar to you. We saw them on the dashboard earlier. I'm just showing them on my report as well, which I can see, you know, before I was at 3.6, and based on my new target, I'll end the year at 5 million. And I can also see the difference between my original budget and my new best case scenario based on for operating expenses. And then I'm just going to scroll down and look at it kind of side by side, right? And this really gives me a great overview of, okay, what are the, you know, what is the change that I made on my assumptions? I just changed the one. But then what does it do to everything within my model? How does it change my metrics? How does it change overall ARR? What does it do to my customer count? And then just flowing down all the way down to my income statement summary. Okay. So we see that increase in revenue associated with the ARR, but we also see some of those increased costs, like more customers means that I'm going to have to buy more hosting space. It also means that I'm going to have to hire more people. Okay, so I see an increase to my payroll costs. I have some of those subscriptions for softwares that are by headcount, so I'm seeing the increase there. And I know that for every new employee, I have to buy them computer equipment. So I also see an increase to my depreciation forecast. And if I finally, then I'm just going to go to the very end here, and I see that my headcount that I required to support the ARR forecast is 2 additional headcount. I will go ahead and stop sharing here.
So I hope that was helpful for people to see how you can actually take all of the things we have been speaking about, goals and assumptions and drivers, and bring them into Jirav, and how easy it was for Adrianna to, within seconds, compare the different scenarios. And if you used Jirav for your annual planning last year, some of the things you'll notice are different in your reports this year are we've added those custom colors, which makes the reports more visually appealing and easier to explain to stakeholders. And we also added those dashboard tiles on top of the tables. So in this example, it was so quick to see the difference between the ARR targets, or show a line graph which shows the differences in operating expenses. So with that, let's go back to our panel. And Katie, what would you say is the importance of having these multiple scenarios and dynamic plans that you can build using Jirav or something else?
Yeah, sure. I mean, I think every industry has different reasons for having dynamic plans. In our industry, we often have to set the next year's budget before understanding what our revenue is going to be, because we don't set our prices. Where a large part of our revenue is government contracts, and oftentimes those reimbursement rates are set long after we've had to finalize the budget. So we have to make some big calls on our expenses without knowing for certainty what our revenue is going to look like, and being able to see those scenarios that we can make good decisions in that time frame is really important. You know, what happens if our rates increase by 2% versus 3% versus 4%? How is that going to change the headcount that we're preparing for today?
Thanks, Katie. Well, Drew, when we were preparing for this, you also had some real life examples of events, very recent ones that, you know, people might need to plan for. Can you please share that?
Yeah, banking crisis, right? See, it feels like a long time ago. It was a couple months ago, or it feels like it was yesterday, depending on how people got involved in it. Yeah, imagine a world where your bank, your assets, your accounts are frozen. What do? What's your plan to pay vendors or even communicate to them and understand what's due and when? That's an example of like just a real like kind of Armageddon-like situation that you hope never ever happens, but you should in your budgeting and annual planning think through like, hey, what happens if I don't have money for a week? What would that mean from a vendor relationship standpoint? What would that mean to my professionals and employees? That scenario, hopefully you never have to whip out the card and use it, but it's like having one of those emergency cards in the hallway of your hotels where it's like, you have a plan. There is a plan in place and it's easy. I'll call it easy. It is something you can follow. But if you don't go through those scenarios and think through them and it's a surprise, wow, that is even more stressful than at least having some sort of playbook in place to at least try to navigate it. Yeah, the banking crisis definitely threw people for a loop. And now it's a real thing that you should plan for in this plan, right?
Yeah. Well, but with planning then, Yarty, this last question is for you. Katie spoke to this earlier. How do you balance needing to respond to these things with accuracy?
Yeah, it's a great question. I think this whole webinar up to this point, we've kind of had one constant, which is change. Everything changes all the time. And Drew and I have talked about how you can make a plan and literally the next minute, once you hit submit, it is old and stale. However, the assumptions and the things that you baked into that should hold true. For example, let's say interest rates right now, I think the prime 30-year mortgage is something like 8.5, which is just crazy. But, you know, if you're putting these things in, you can kind of get an idea, hey, maybe in a year from now, maybe it's going to come down a point, maybe it goes up a point. But at least when you're building these plans, you're getting a sense of where we're heading. And ultimately, it comes down to what we call the Pareto principle, the 80-20 rule. You know, your goal isn't to get to 99%. The goal is, hey, what are the 20% of things that you're doing that are driving 80% of those results? So at some point when you're building up your plans and your budgets, that incremental, you know, effectiveness isn't going to get bigger after that point. So really think about everything that Adrianna shared, Katie shared, Drew shared. You know, what are those core drivers? What are those assumptions? Do your actuals reflect those assumptions? You know, if my CAC is $500, next month it's like $1,000. Something fundamentally has changed in your business. So taking all that into effect and you're building your plan, you'll be able to, not only, as Katie said earlier, you're going to build up this muscle. You're going to be practicing it over and over and over. And over time, that speed and accuracy will both go up at the same time. But I always harp on focus on that Pareto principle as much as possible. And just always remember not to get in the way of execution, because at the end of the day, you still got to execute and deliver the work and help your companies grow.
Thanks, Drew. Thanks, Yarty. Well, here are our forecasting tips that we really want to strive for long-term accuracy over short-term precision. And again, model for at least 2 scenarios at all times. As you've seen using Jirav, you can also collaborate with your team to validate assumptions. This will help you save time and be like, oh, does it actually make sense, this rate we considered for how much we need to hire? That shouldn't be a surprise to anyone. And then at the last thing here is you really want to have a monthly reporting cadence to fine tune and forecast your model to see if it is still relevant, like Katie said earlier. And speaking of a monthly reporting cadence, I'm going to pass over to Adrianna to speak about the last piece in the framework.
Mm-hmm. Great. So the last piece in our framework is tracking progress. So we set the goal now, we built the model, we tweaked our assumptions. Well, how do we know if we did it right? We're going to do that by tracking our progress. I showed an example in Jirav of a dashboard and a report. And as you're building those out, you really want to focus in on the key items that you want to share with the company and also hold people accountable to. So if one of your goals was the year was to rein in the spend for your marketing department, not to single them out, but probably the marketing department, you want to build a dashboard for them that shows them actuals versus budget that they can go in and they can look at very easily, make sure that they can see how they're performing against what they said they were going to do. So I definitely encourage you to create different lenses through reporting packages and dashboards for different audiences, because what you care about versus what your CEO cares about versus what your department heads care about is all going to be different.
Right. Well, Drew, what is the importance of rolling forward your plan?
Oh, wow. So I like to compare this to, I'll call it a GPS, but it's really the app on your phone nowadays, right? There's no more like printouts or anything like that. So when you drive somewhere and you type it into your phone and you say, okay, I'm going to go from point A to point B, that right before your trip, by punching that in and getting the destination and the time to destination and the path you're going to go, it's kind of like doing a budget. It's before you take the trip and you have an idea like, hey, I know it's going to take me 1 hour to get to this place and I'm going to take the highway here and the back roads here. Well, then you get in the car and then what happens? You don't turn off your phone and the navigation app because, well, information might change, right? There could be an accident, there could be traffic buildup. So by keeping your car app and navigation app on, you're constantly making new decisions with latest and greatest information. So that is like rolling forward your budget. You should constantly, as you're in the race or on the destination or the path to the destination, checking in on what's going on, both with your actuals. So did things come to fruition that you thought they would? But also the things in the future that, like Katie was talking about, hey, I now know what I can charge for pricing. So I'm now going to update that and reflect that in my updated roll forward forecast. So it's super critical because, like Yarty said before, like the second you submit this thing, this budget, this annual plan, it's stale. And that's not a bad thing. It just means that you need to be on the ball for changes, because if you're not, well, by the end of the year, the results you get are going to be very different likely. And if they're not, you are very lucky and should go to a casino right away. But they will be very different than what you originally intended, just because there's new information.
Thank you. Well, Katie, we are going to jump into Q&A in just a few minutes, but could you share how important it is to have a tool that actually helps you report in that flexible manner? And maybe even speak about how Jirav has helped you do that.
Yeah, sure. Well, like everyone said, things are always changing. And so not only are things changing, but sometimes depending on how those changes are impacting your business, you have different audiences who need to see those changes and how they affect your organization or your programs real time. And particularly for us in the nonprofit world, we have a lot of audiences. Anyone who's ever had to rely on grant reporting, for example, knows that every foundation is looking for different information in different formats, and often in a very specific manner. So having a tool that allows you to report back on whether it's a program's impact or a program-specific P&L in the format that those funders are looking for, it's going to save time in the long run versus trying to build this out in a more kind of long-form manner.
Thank you. Well, here are our reporting takeaways. You want to create reporting packages which are customized to your stakeholders. And in Jirav, you can do that. You can build multiple reporting packages. Maybe one is for your investors, maybe one is for internal use. And you really got to think back to what were those KPIs and goals that I had set at the start, and make sure that is reflected in the report, whether it's through dashboards or through tables. You want to actually show them in the report. And finally, you want to be tracking your progress regularly, adjusting your drivers and assumptions so that the whole planning process is not a one and done, but an ongoing activity that you build. What's next? What's coming up next? We have a few things that we are going to recommend you do. We are going to recommend you discuss the goals at the leadership level. Make sure you have those goals connected to KPIs and metrics. And then finally, communicate the KPIs across the company. Because unless people are on board and aware of what's coming up, it may not happen. I have just told you a very simplified version of what Drew has and Yarty have written for us. It will be a checklist that we'll deliver to you after the call, just walking you through the process of here are the things you need to be thinking of as a next step, as a follow-up to this webinar. I'm leaving time for Q&A because I saw a lot of questions and answers popping up as we were going through this webinar. So with that, I'm going to actually go to the Q&A section here, and we have several questions we have already answered and some that we will be answering. So the first question was around, how are you pulling in customer counts? Do you use a separate software and manually input into Jirav? Is there an API? The answer to that is we use Google Sheets to pull in operational data like customer count from your CRM or other tracking tools. And we can set up a call to discuss that further. The other question was, next question was, how does your solution allow for fiscal period projections and forecasting in addition to budgets? The answer to that is yes, we can roll forward actuals monthly and refine the projections as the year goes on. Adrianna, do you want to read out some of the answered questions while I process some others? I'll just give you a second to review. Will there be a copy of the presentation available for review? Yes, we will have and we will have that. We will be sending that after.
Yeah, I could jump in. Yes, I see we were asked, what does ARR stand for in the discussion? And I apologize for not saying that. ARR is going to be our annual recurring revenue. A lot of times for software companies, they like to look at the annualized revenue rather than the monthly revenue, because typically they're a one-year subscription.
Another question. Go ahead.
I was going to say, another question we had here was, can we enter in detailed items for particular expenses? For example, for research, you might want to list out each vendor that is associated with that research project. And the answer is yes, we can definitely add in additional detail beyond the GL account. That could be a vendor, it could be a consultant. Everything is going to be additive in nature and can add up to the total forecast. Someone else asked if Jirav offers consulting services. Absolutely. That would be with my team. So happy to help you guys out with any sort of consulting as you're building out your budgets or your forecasts.
And then can you use Jirav to build a capital budget? And yes, Jirav can plan for those capital purchases, including depreciation calculations. And finally, there was a question around templates. And if what Adrianna showed, can we provide a basic framework that can be reused? And we have many industry templates with best practices that can be used as a starting point for your financial model. Then here's a question. Typically, and this might be for the whole panel, typically how long does the annual budgeting planning process take? Is it usually one meeting or a series of meetings? Yarty, could you take that one?
So really depends. If you're at a Fortune 100, that's probably going to be a 4-month process. Very, very long, very, very fun. And I say that sarcastically. But it really depends on the size of your company. If you're, let's say, a 10-person shop, I mean, ideally, you'd have something within 30 days. You could really get in there. You'd have your transactional data. I'll make the assumption you have Jirav, so you'll be able to plug all that information in. You'll be able to quickly look at that dashboard and go, does that assumption make sense? Oh, wait a minute. I put in 12% interest rate. That doesn't make any sense at all. Let me go back and fix that. Larger the company, sometimes things fall through the cracks. And, that's why when you're at a big company, as an example, sometimes they just kind of float the expenses through. They just go, it's fine. But when you have a software like Jirav, where your stakeholders are very close to the numbers, you're close to the numbers, you can move a lot faster and you're more agile as a result. So it really depends. If you're a small company, I mean, you can probably get it done within 30, 60 days. If you're at a big company, enterprise level, I mean, it could be up to 4 months. You know, my old company, when I worked at a Fortune 100, we would have 2 planning cycles, not 1, but 2. So we'd have the first planning and then we do the second planning. So it really depends on the size of the company, but the smaller the company, the faster it should be ideally.
Thanks, Yarty. There's a comment here. The key to success with any budgeting or forecasting modeling against actual is consistency in the financial statement preparation, along with completeness and accuracies of entries at the point you're running your analysis. And we couldn't agree more, Mike. Here's another question around, in Jirav, how do you know what should be an assumption versus a custom table with data? Adrianna, could you respond to that one live?
Yes, I can. So specifically in Jirav, the concept of an assumption is for all time periods, right? You're setting an assumption for the year that benefits are $1,000 per head count. And if that assumption should change over time, then that would be better for a custom table, because the custom tables have a concept of time, right? So maybe for like customer count, you'd want to put it in a custom table, but maybe your average contract value would be an assumption that stays steady.
Thank you. Here's another question. Do we have templates for construction or custom builder companies? I believe we do, but that's something I can follow up with you, Shubham, after this call. Let me see. I don't see any other live questions that we haven't answered yet. Wait, hold on. Something just came in. There was a question around, once you are in Jirav, how do you export and import functionality? Are there any intermediary software tools you can use to move data from Foundant to Jirav and back? And we would use Google Sheets or Excel to import data into Jirav. We have integrations with a number of direct integrations with a number of software such as QuickBooks Online, Xero, Gusto, ADP, but and we can follow up with you more about your needs. But for what we do not have a direct integration with, you can easily use Google Sheets or Excel to import that into Jirav. And similarly, you can also export it back out using Google Sheets and Excel. And the reports we were showing earlier, you can export them as a PDF in case you want to present them to your stakeholders. Okay, great. I see we are almost at time. Well, from a CPA firm perspective, is the planning process done internally in a company or with the help of a external CPA? I'm not sure I understand the question, but if you are a CPA firm, we have a accounting firm partner program, and you would have clients who you help plan for using Jirav. Please reach out to me directly, and I will be happy to direct you to someone on our team who can answer that question for you. But again, my email address will be, you will get the recording, the slides, and more resources, including that what's next checklist that Drew and Yarty have built for us as a follow-up to this webinar. Well, thank you everyone for your time. And wow, I'll follow up. Earl, I saw a question come in. We'll follow up with you. Thank you. Bye, everyone. Thank you, panel.
Thank you.